Hi, I'm MJR Invests, and today I'll be using examples to talk through 14 tips that all investors should know. The first tip is about the benefit of holding stocks for the long term. This shows the total real market returns from 1871 to 2012. The grey area represents where Wall Street normally plays, turning over stocks and chasing quick gains for shareholders. However, what you can see is that this figure shows that the percentage of periods that earned a positive return over 4 months is actually only around 62%. You as an individual investor have a much greater advantage in that you can simply buy and hold a stock. This is in the green area, and by holding stocks for 15 years, you actually increase the probability of making a positive return to over 95%. If you stick to tip 1, then tip 2 is to simply ignore those who say investing is gambling. Here you can see the odds of making money from a large index fund like the S&P 500 over different time periods. The reason it isn't gambling is because gambling normally has odds that are against you. Investing is different, because if you hold an index fund for 15 years, then the odds of making money are pretty much 100%. Tip 3 is to not listen to opinions on reasons to sell. This shows the returns of the S&P 500 from 2009 to 2019 with a whole host of reasons of why to sell. What you can see is that if you sold for any of these reasons, you'd probably be worse off, as you'll have missed the following boom that came after the dip. This happened with COVID in 2020 also, when the stock market decreased, only to rebound to an all-time high. The tips so far tie into number 4. Avoid emotional investing at all costs. It's human instinct to buy into herd mentality, but this is dangerous with investing. When the stock market is up, the excitement hits and people rush to buy. However, successful investors recognize this as the point of maximum financial risk. On the flip side, when the stock market starts to go down, people panic and want to get out of the stock market, but this is actually the point of maximum financial opportunity. To beat your emotions, the best thing to do is assign a set amount of money each month and invest it on a set date. That way, you are a robotic investor who buys in for the long term regardless of what the stock market is doing, and over time you'll buy some peaks and some dips, but over time all of this will increase to produce financial returns. Tip 5 is to become an index fund investor. The average investor returned 3.6% from 2002 to 2021 per year, but the S&P 500, the American Index Fund, returned 9.5% per year. Most investors go against the first few tips I've said and will be the overall losers. They are emotional, follow the crowds, invest for the short term, and panic sell when someone gives them a reason to. In order to beat this, most people will be much better off by just sticking their money in an index fund each month and forgetting about it. Tip 6 is to not listen to bull versus bear markets. For those of you who don't know, bull versus bear markets are often referred to in investment talk, but refer to the fighting action of both animals. Bulls normally hit upwards, whereas bears strike downwards. So a bull market is one going up, and a bear market is one going down. This shows the S&P 500 from 1926 to 2019. The average bull market, i.e. going up, lasted 6.6 years with a total cumulative return of 339%. The average bear market, i.e. going down, only lasted 1.3 years with a cumulative loss of 38%. Bear markets are normally short and hard to predict, and based on my previous tips, it would just be much better to just buy and hold. Tip 7 is that stocks are king. Here shows the return of different assets from 1801 to 2021. The thought that cash is king is completely flawed, as the purchasing power of $1 has consistently decreased. Stocks, however, are the complete opposite. $1 invested in 1801 would now be worth over $2.3 million, and it's not slowing down anytime soon. Tip 8 is that stock market dips will inevitably come. They always have, and they always will. 95% of years have had a dip of 5% or worse, and 5% of years have had a dip of 40% or worse. It's hard to predict when the dips will happen, so it is best to just accept them when they come, but don't panic about them. Tip 9 is to appreciate that some years will be good and some will not. This shows categories of investment returns from minus 50 to minus 40% per year to plus 50 to 60% per year. Most returns in the middle are approximately 0 to 10%. 1 year has returned minus 50 to minus 40%, and 5 years have returned 50 to 60%. Appreciate there'll be good years and bad years, but this is slightly skewed to good years. Tip 10 is that compound interest is your friend. Someone investing at the age of 21 but stops by the age of 30 will accumulate more investment wealth at the age of 67 than someone who starts at the age of 30 and invests for the next 37 years. This is due to the power of compound interest. Stocks make dividends, which themselves make dividends when reinvested. This snowballs over time, so the earlier you start, the better. Tip 11 is to avoid comparison. In the social media age, it is easy to compare yourself to others. Most people think investments mean quick rewards, as they compare themselves to the minority who are extremely successful, such as Michael Burry or Warren Buffett. However, you have to let time take its toll through the power of compounding. It will be slow to begin with and then speed up. Tip 12 is to build the foundations for the accelerated growth. As mentioned, the start will be slow. In this example of investing $10,000 per year with a yearly return of 10% takes 7 years to hit $100,000, but just 2 years to grow from $500,000 to $600,000. This is why successful investors often say that their first $100,000 was the hardest. Tip 13 is to ignore politics. This shows the growth of investments during Republican or Democratic presidencies in the USA. If it was to make this all grey, then you'd have no idea where these zones were. Politics does not influence the stock market, so simply ignore it. Tip 14 is to only hold enough cash to cover your short-term needs and potential emergencies. The buying power of money is constantly decreasing as it is eaten by inflation. In order to beat this, you must invest your money and make it work for you. If you enjoyed these tips, make sure to hit that like and subscribe button. I post weekly videos and look forward to sharing more investment research and tips in the future.